Another stock with a strong moat or competitive advantage is the Hershey Company. The Hershey Company is clearly in a negative trend. It has declined by 31% since the all-time high, making the valuation much more attractive again. Let's first simply take a look at the fair value estimate from Morningstar. The Hershey Company receives a Morningstar rating of 4 stars, and the fair value according to this company is $210. The current price is $180, so it may be that the Hershey Company is slightly undervalued in the short term. However, although I am familiar with the company itself, I have never really delved deeply into it. I do know it has an economic moat, but I do not own any shares in it myself, so you are always less powerful in your analysis. Therefore, I will present some data and graphs for inspiration so that you can form your own decision-making regarding the Hershey Company. Of course, you also need to look at the annual report and, even more importantly, consider the future and think of scenarios. The average price target from analysts is around 200, so they also indicate that it could potentially be a buy in the short term, and the consensus is still a hold. This could certainly be in relation to other potential stocks. Looking at the historical valuation, we see that the Hershey Company has actually been well above the fair value ratio of PE 15 for quite some time. The Hershey Company has been following a PE ratio around PE 20 for a reasonable period, which is represented by the blue line, what they call the normal multiple for this company. Actually, you need to zoom in a bit to, for example, 7 years, and then we see that for a long time the price has been below the standard multiples. So from that perspective, it may be interesting, but it is still above the traditional PE of 15. Let's look at the forecasting tool. Well, nobody can forecast. We know that, Nassim Taleb. The black swan events, but also just randomness and fullness, all those kinds of things. It is just difficult to predict the future, but what we can do is at least perhaps look ahead to next year. In this case, 22 analysts and 13 analysts have made an attempt, and they come up with a consensus estimate, or a weighted average of analysts. With an EPS of around 9 and 9.8, this results in a slight contraction compared to this year. And for 2026, a small growth of 8%. That's not very much, even though it is a strong company. Revenue seems to be relatively lower in the short term. The normal multiple is around 24 based on the 2 5-year averages. Maybe we should actually base it on 10-year-olds, but then you have 24, so that's still the same. Despite this contraction in 2025 and a slight increase in 2026, the stock could still deliver returns according to the normal multiple and relatively high, averaging 15% per year. However, if we look at what the normal PE ratio should be for this type of company with this short-term growth expectation, you would have a PE ratio of 12 and would realize a loss of an additional minus 30% in total. I think that is on the low side. For example, if you take 16, you would hardly make any profit or loss. Actually, you should start thinking about the valuation of the Hershey Company here, and I can assure you that there are much better stocks available at this moment. It is quite clear that the opportunities weigh in your favor, and with the Hershey Company, it is clearly the case or not. In other words, questionable, so you need to analyze more. There may be opportunities there as well. But why go through so much effort when there are simply easier and better companies available that have potentially higher upside potential? Also, check our website for value, dividend, and weekly growth stock analyses, including the monthly update on stocks that have the potential to achieve much higher returns. In this case, Hershey. It is interesting to note that the return on equity is particularly high, and that is also one of the reasons why we do this. The equity is bizarre, and thus always leads to outperformance compared to the industry. And when we look at margins, we see a somewhat similar story. It also reaches higher, a higher cross margin in this case, with a difference of 16% compared to the industry. Looking at the operating margin or EBITDA margin is around 30% compared to about 14% for the industry. So, quite interesting. The Hershey Company has very strong profitability, but the valuation is currently not very attractive compared to the potential growth. But do we see that reflected? We see it reflected in the luck ratio, which is 5. The luck ratio takes into account the EPS growth over the next 5 years compared to the current PI, and I must say 5 is quite low. In this case, the higher the worse, so a bad luck ratio of 0 would actually be very good, but that almost doesn't exist. But for example, 0.5 is seen more often, which means that the Earth is potentially very undervalued. That is, of course, what you need to do if you want to invest in this. They should hold, for example, crypto cash over the next year is 14, and that is just neutral. It seems that the company is currently operating around intrinsic value without actually conducting in-depth analyses, and that is, of course, what you need to do if you want to invest in this. But it could potentially be an interesting dividend stock. The dividend is around 2.8%, and there is also dividend growth. Well, in any case, for next year they expect a dividend growth of 13%. However, in terms of revenue growth and EBITDA growth, it seems less interesting in the short term. The question is, of course, can the Hershey Company grow exceptionally high in the long term? Looking at the market value, 37 billion in market value is not an extremely large company. Well, large means that revenue and profit growth will naturally be somewhat lower in the long term, especially for this type of earning model. However, they do achieve higher profitability, which can be interesting for dividend investors. The debt is manageable in this case, and a bit of cash seems to indicate that, at least in terms of solvency, things are okay in the short term. Look at the profitability grade, which is excellent for the Hershey Company, and this shows that it is a superior company. In other words, a company with a demonstrable, sustainable competitive advantage. This is especially evident when looking at the 5-year averages. The gross margin, as we indicated earlier, is well above the sector median. In this case, 35%, resulting in an outperformance of nearly 10%. The net income margin has also averaged around 16% for the past 5 years. The return on equity is very high, as is the return on total capital, so this company scores very high on profitability. However, there may be a better opportunity arising in the short term. Zegshenk gives a sell. Why? Good question. The price target from Hershey is $200, so that aligns with other analysts who also have a target around $200. Morningstar's fair value S&M is around 210. So it actually seems that the upside potential is not very high. The question is what the revenue will do in 2025, as the market is, of course, looking ahead. And in the case of Hershey Company, it is a very well-known company. Many analysts have made an assessment, so usually market efficiency plays a role here. You often find undervalued companies when the market is inefficient, which is usually the case with smaller companies or those that are disliked. But the Hershey Company seems to be fairly valued, meaning you can achieve a decent return, but may not outperform the market. Additionally, since the PE ratio of the Hershey Company is slightly lower than that of the S&P 500 at the moment, it raises the question of whether it is truly the best choice. As I already mentioned, since the Altium high, the value has decreased by 33%. Technical analysts will look at a support level. We can set it on candles. Then we see here a negative candle line. But more importantly is the MACD. No, the MAC, no. It is therefore a question of whether at the current support level around 180, it finds support here and moves upward, creating a downward or horizontal movement, or if the stock will continue to rise. This is purely technical analysis. I don't do much with it when it comes to long-term investing. However, you should include this game in your overall decision-making, not as a decisive overriding factor, but more as a tool. The most important thing is to invest in companies that are undervalued and also have a competitive advantage. Well, Hershey seems slightly undervalued. The undervaluation may be greater if revenue growth and profit growth are higher than expected. But that is the question. Only you can determine that after a lot of research, and that is why this analysis is the inspiration. I am curious about what you think of the Hershey Company. Let me know.